This is Angel Insights brought to you by SyndicateRoom. This is the show that delves inside the world of angel investing to discover the tips, tactics and strategies of the world's best angels. And today does not disappoint as we welcome Sean Black to the show. Now, Sean was on the founding team at Trulia, which was acquired by Zillow for $2.5 billion reportedly. Sean was also the founder and CEO at Crunched, which was acquired by competitor ClearSlide. And on the angel investing side, he's an investor at Correlation Ventures and a prominent angel in several marketplace companies, including SeatGeek, NerdWallet, Zeel, Paintzen, Peach, and the home improvement app Smith. And if you're loving the show, head over to our learning platform at SyndicateRoom Learn, where you can find a whole host of articles and further interviews. But enough from me, so I'll hand over to the man himself. Ladies and gents, may I introduce Sean Black. Sean, a very warm welcome to the show. It's a real pleasure to have you on. Thanks so much for joining us today.
Thanks for having me, Harry.
Now, I'd love to kick off today's show by hearing about your background and how you made your way into the tech and startup world.
Sure. I'll go back as far as I think anybody could stand. I think the company...
well, you're a very young chap. It won't be long.
Well, I think the company that most people are familiar with is Trulia.com, where I was on the founding team. We started that company in late 2005, built an amazing team, an amazing product, and went public on the New York Stock Exchange in 2012, and then was acquired 2 years later by our biggest competitor, Zillow, for about $2.5 billion. About 2010, so I ran at Trulia, did a bit of everything the first couple of years, ultimately led the sales operations team, which by the time we were acquired was nearly 600 people. And we built a lot of tech to make as much of that process automated as possible. And I took a lot of the ideas and technology out of Trulia and built a company around it called Sales Crunch, which originally we changed the name to Crunched, and had some of the same investors, including Excel and First Round Capital, and sold that company 3 years later to ClearSlide on the West Coast. The combined company's now raised about $90 million and is, doing pretty well.
And then in terms of how it felt to be part of the rocket ship that was Trulia, how did it feel for you as one of the founding team being part of such a momentous company?
The best word to describe it is just proud. I continue to be proud of the people that we managed to bring on and the success that we had.
Were there any big lessons that you learned from the acquisition and from leaving Trulia and starting a company on your own? Were there any takeaways as well from Trulia that you took to Crunched?
I think the most important thing as we were building was the people, not only that we brought onto the team, but that we had come on as investors. We were pretty determined to have the best investors involved from the beginning, and we had a lot of options, fortunately, early on. And so one of our first investors was Accel Capital, and Sequoia turned us down 2 or 3 times before finally coming in at the end, the last round. And a good example there was, we raised that last round literally days before the whole 2008 RIP Good Times Sequoia memo got leaked.
Yep.
We had a little bit we were all brought in as portfolio companies a couple of weeks ahead of before that actually got leaked. So we knew that deck was going to be floating around. And we raised the money very opportunistically. And we took a worse valuation at the time to have Sequoia involved. And we did it because we just knew that having them involved would mean that we would be able to recruit better people and continue to build a team that would get us all the way to the finish line. So I guess when I pulled Sales Crunch out of Trulia and I went to raise money, we were as a brand, Trulia was pretty respected, and so I had options in terms of who I got to have involved. Had a pretty high bar on who I chose, and I ended up with First Round Capital and Alfred Lin, who at the time was still the CFO and COO at Zappos, is now a partner at Sequoia, and Excel, Teresa Gao, who now has her own fund. I just had amazing people. So I guess the big lessons were the people are the most important thing. The passion is probably right behind that, and everything else kind of helps drive itself. Big problem too, obviously, to solve.
And you said there about the people in terms of not just the team, but the investors. So, and you said you had the best there at Trulia in the early days and as you progress. So how did you define the best, and how do you think founders and startups should address choosing the right investor for them?
Yeah, so I guess all things being equal, frankly, the better brands bring you a halo effect. there's somewhat of a self-fulfilling prophecy for those guys. It helps a lot because you have the halo of the brand, but it also helps a lot because you have the network. So somebody asked me last night at an Angel List event how I get my angel deal flow, and I said, frankly, it's just my personal network, and most of that is thanks to the last 2 companies I started and the VCs that were involved. First round, as the biggest example, at the time when I was a portfolio CEO, we had 200 companies, and First Round was awesome at getting us together 2 or 3 times a year. And so, I consider and can still consider those guys my friends. Mm-hmm. And, Excel did the same thing on an annual basis and a virtual basis in terms of getting all these amazing people together. So, yeah, I mean, how do you define the best in the CEO? I think first and foremost, like if, go to the best brand, go to the best person or company that has a lot of experience in your domain, if you can. So there's a lot of shared learnings. And then the third most important thing is make sure you can get along with them, because it's like a marriage, as they say. It's a 10-year journey. And there's a lot of bumps along the way. And you want somebody in the board meeting who's not going to freak out on you when things don't go as planned, and in fact just the opposite, that jump in and roll up their sleeves and help you.
And in terms of the founders and startups evaluating the investors, I'd love to flip hats now, and you've been on both sides of the table, as you mentioned there, with your angel investments. So how then have you evaluated startup founders? The opposite now from what we just spoke about. What do you look at in them? Is there a kind of an eye of the tiger you look for?
Yeah, I think people doing things for the right reason. I think especially in the last couple of years, where you have everybody jumping in, the would-be entrepreneurs that don't really understand what's involved, which is okay, right? Like, from the outside looking in, if you've never been an entrepreneur before, everything looks amazing, and it is, but it's also really hard. So hope there's a lot more awareness around how hard it is now, which is good, because I think it's going in wide, eyes wide open is a great thing. So I think, for entrepreneurs, I look for people that are doing it for the right reasons. And I feel like have the wherewithal to persevere through the good and the bad and the ugly.
Absolutely. And I'm always quite intrigued by how an angel looks at an early stage founder. And do you like the founder themselves to have had deep domain expertise in the field that they're entering? Or do you feel that naivety actually is a good thing, as it stops you being aware of the pitfalls? Where do you stand on this knowledge gap for founders?
Yeah, for me, it's the latter. None of us really knew. Look, if any of us who founded Trulia knew what we ultimately knew 2 years later, I don't think we would have done it.
Yeah.
And I feel like you kind of need. That's one reason. Like, you just know, the sausage making is always a lot less sexy in any industry, including what you think are the most sexiest industries, like TV. The behind the scenes stuff is just really not sexy at all. And so I believe to some extent having some naivete is really beneficial, because you don't know what everybody else thinks is not possible. It helps that you have some insight, though, into a problem or an opportunity that other people don't have. And so maybe you got that from being tangentially involved in the industry or in the industry. So I don't necessarily hold it against someone, but I don't think it's
But you don't require the deep domain, no. And we spoke there about your angel kind of network and the people around you in the network. And you're a mentor with the likes of 500 and Techstars. So I mean, firstly, what does that bring to you as an angel investor? Is that a deal flow? Is that a expertise in the market? What do you get from that?
So when I joined both of those organizations, I did it for a very different reason. I did it a couple of months before the acquisition of SalesCrunch closed, knowing that I was going to take some time off and already feeling paranoid that I was going to become irrelevant by taking a year off. I think entrepreneurs get paranoid about that pretty quickly. It wouldn't have been true. So I a little bit felt like, I could have, got a pulse on what was happening and bubbled up, because I was so consumed with what I was doing for the previous 3 years. And also just to give back. I felt like so many people had helped me and helped us in general along the way, that I felt like it was a good opportunity to selflessly give back. Mm-hmm. So there was a bit of both selfishness and selflessness involved in that. And I didn't know that I wanted to be an angel investor, to be honest. I started doing it as a way to kind of figure out what I wanted to do next, in terms of like what kind of business and what space. And so I thought getting involved with lots of other companies could give me insights into spaces that I didn't have any into. So I literally remember like and I really went all in on it. Like I was really like the first couple of months in Techstars and 500, like I was on the phone most of the day helping these folks, not knowing how it was ultimately going to come back to me. I was just really loving it and having fun. And so, ultimately it's led to good deal flow, but I think more than anything, it's led to good karma because a lot of those entrepreneurs go out into the world after an intense 3 months, usually with Techstars, for example, and they ultimately refer lots of other companies and their peer sets and whoever they're sharing office space with back to you. So yeah, that definitely did ultimately end up in deal flow. I wasn't thinking about it going in.
And you said there about advising startups. Startups nowadays seem to have kind of, actually strangely, a plethora of different advice options coming at them from a variety of different people. How do you recommend that startups can filter through that noise and choose the right mentor and advice for them?
Yeah, you're right. There was a lot less of it a couple of years ago. There's way too much of it now. And I think you could get into a situation. I think you always could, but I think more than ever, you can get to a situation where you're like, it's like analysis paralysis. You just have all these people telling you, none of them really know what you're dealing with every day or know your industry or your opportunity as well as you do. So I would say you can start with that shotgun approach. What Techstars does, which I think is really interesting now, is they'll have all the mentors meet all the companies on the first week of the program. Both sides figure out like which of the mentors that can add the most value, and they just kind of get along with as really well personality wise, which is a good fit. I think that's actually a really good way to do it. Like meet everyone and then pick and choose who you think would be fun to work with, who would be valuable to work with, and listen to those people and, call on them as much as they'll let you.
And what did you make of Sam Altman's incubator hopping article on startups jumping between accelerators? Do you think that kind of a startup going through multiple accelerators is a good thing? Would you view it negatively? What's your take on this?
Yeah, I think there were two sides to that, right? One was don't apply to multiple accelerators versus going through multiple accelerators. So on the don't apply to multiple, I agree with McClure on that. I think you should apply to, it's like a college, like the analogy he made. You should apply to a few, and ultimately, much like the mentor interviews, figure out which one is right for you and the company you're building. As for going through a couple of them, when I see that, as an angel investor, it does raise a question on like, why would you go through more than one? What didn't you learn the first time? Why would you take like more dilution? So I guess it's really probably circumstantial on what you're trying to get out of it. If one accelerator has a deep domain expertise in something the way McClure does with online consumer acquisition, and another can offer you something completely different, then I think it makes sense.
No, I'm with you completely. And in terms of kind of startups coming out of accelerators and moving to the VC funding stages, I'm very intrigued, obviously being quite a VC specific guy. I'm very intrigued by your work with Correlation Ventures, because they're an algorithm centric VC, am I right?
Yeah, Correlation is amazing. So Correlation Ventures is a $175 million co-investment fund, and I'll explain what that means in a minute. The first fund was $175 million, and we just announced the second $175 million fund. So the way I met these guys was actually, it was an introduction through First Round Capital when we were raising our last round at Crunched. The introduction from them was like, look, these guys were entrepreneurs before. They thought the whole process of having to find your lead and then find the second chair and go through all the diligence twice was insane. So what they did was basically sucked in all of the data around all the investments in the last several years, including the partners that were involved, used that data and 29 other pieces of information to figure out the likelihood of success. And so Correlation will co-invest with a lead investor for which we have data. And we'll do it with a very short timeline. So we'll usually give a yes or no answer within a week, 2 at the most. And we do it without actually ever meeting the entrepreneur. We figure out who the lead investor is, and we do our homework from there. We get access to the deal room and all the same data points that every other investor does. And we crunch the numbers, and we figure out the likelihood that that company will be successful. And it's the probability that the algorithm is pretty darn effective. And what it's great about it is it helps entrepreneurs just get back to work and not spend so much time fundraising. And so we'll invest anything from as little as $50,000 to as much as $4 million in any one round. The only caveat is it has to be led by an institutional investor, a venture capitalist, versus a corporate investor, a strategic investor. Strategic can be involved, but they can't be leading because their return profile is totally different.
Mm-hmm. Absolutely. Is this the future then of VC, do you think? I mean, are we going to see a lot more algorithmic deal sourcing?
I don't know. I think our model wouldn't work without the VCs who are doing it the way they've been doing it with institutional knowledge and making decisions and doing due diligence. We sort of piggyback off of what they do. So I don't think I definitely don't think the whole industry is going to go that way. And for as long as possible, I hope we have the advantage in having all the learnings over the last couple of years of how we tweak the algorithm to continually get better. But we've managed to spot some really interesting things. I mean, one example is Casper here in New York, which is, if you don't know, e-commerce company.
It's a mattress.
It's the mattresses in a box.
Of course. Casper are famous, very famous.
Yeah, but nobody would do that deal in the beginning. And ultimately, Ben Lear finally led it from Lear Hippo Ventures, and we followed in on it. It was one of those everybody squinted their eyes at it kind of thing, but that thing's done phenomenally well. And it didn't bother us that, a lot of people had turned them down because we only needed the one in Ben to take the lead on it. Uh-huh. And the algorithm said, thumbs up.
And considering you never get to meet the entrepreneur themselves, do you still feel you have the same effectiveness in terms of value add when they need it?
So here's the difference. Correlation is a fund. The reason they don't necessarily meet the entrepreneur is they want this to be objective, right? And so as soon as you meet someone, that starts to the objectivity starts to go away one way or the other. Mm-hmm. In my case, I'm sort of a scout for them on the East Coast because it's a Palo Alto-based fund. And they come out here on the plane once in a while, but I'm entrenched in the New York ecosystem. So actually, I end up when I'm sourcing deals, it's because I have a relationship with the founding team or have been introduced through a different relationship. I think in that case, like as a scout for them, I have a different relationship with the entrepreneurs than they do. But inevitably, the partners at the fund are still ultimately never meeting in person, usually the entrepreneur. It's not like they have anything against it. It's just like we're trying to save time. So like getting on a plane or one way or the other just makes it, take longer.
Absolutely.
What we do, however, is there's a 30-minute call with the CEO directly and then a 30-minute call with the lead investor to make sure that, everything is as it looks on paper. But again, like the value prop from Correlation's perspective is we are like the most lightweight investor that you'll have. We don't take a board seat. There's no real overhead. We just help you get the deal done and move on quickly.
Yeah, absolutely. And I'd love to dive into a quick fire round now. So I say a short statement and you hit me with about a 30-second quick fire.
God, wasn't that what we were doing all this time? Go for it.
So your favorite book and why?
Persuasion, which I feel like has been recommended all too often.
Is that Roberto Cialdini?
Yeah, exactly. Mm-hmm. Yeah, and it just tells you about like how people think and how basically how you can play into that.
Yeah, my first ever interview guest, Guy Kawasaki, said that as his favorite book.
Yeah. I think it helps as an entrepreneur. It really helps understand why people make the decisions, especially if you're a consumer, but really just people in general, right? Even if you're a B2B company, ultimately there's a human being on the other side making that decision and like the psychology of how people make those decisions. If a lot of NLP, what Tony Robbins sort of champions is that same kind of psychology. How do you get into people's heads and figure out how they make decisions? So I think it's sort of like foundational from an entrepreneur's perspective to always think about their customer.
And then what's an overhyped and what's an underhyped sector to you?
Yeah, food came to mind when you said that. I looked at food really hard 2 years ago, and I think why it's overhyped is there are very few companies. It's sort of like a winner-takes-all approach, and depending on the model that you have and the economics of let's say, like a Munchery are like, they're just going to out-engineer you to get the cost-effectiveness down, and there's a, economy of scale that no one else can get once the first one has sort of gotten away with it. So I would say food is probably a little bit, but I also think people are realizing it now that it's sort of overdone, and kind of whoever's there is probably going to remain the foreseeable future of the battling it out.
Mm-hmm. And then underhyped, what excites you? What is it? It could be cybersecurity, it could be fintech. What's it for you?
Yeah, neither of those things get me excited, to be honest. They seem like they have lots of runway that just don't personally get to me. I don't know. My thesis. So when I look a lot at marketplace companies specifically, and in more generally network.
Because you were a SeatGeek, weren't you?
Well, I was an investor in SeatGeek. It's a good example of the kind. If you look at the investments that I personally made, NerdWallet and SeatGeek, and Zeel and Paintzen here in New York, they're all marketplaces. I like marketplaces because that's what Trulia was. More importantly, I like network effect businesses because having had the experience of a consumer-facing network effect business versus a SaaS business, I just appreciate fully now how much more defensible the former is. And so marketplaces are really hard to build, because you're building basically two businesses at once, but they're also, once you do build them, really hard for anyone else to disrupt. And
then what's your favorite blog or newsletter?
Probably the ones that everybody else reads. I read Mark Schuster's blog. It's not every day, but whenever it comes out, and it takes almost a day to read it because it's so long. Fred Wilson's CB Insights increasingly. I think they're getting a little bit jumping the shark with some of the headline stuff that they're doing these days, but
it's quite bold sometimes.
It's a little bit out there. I'm sure it gets people. It's clickbait. It gets people to open it more and more, I'm sure. But the data is really good underneath of it. Matterport is similar types of data. So yeah, I think there's lots of stuff. From a data analytics perspective. Thomas Tungaz at Redpoint.
Amazing newsletter.
Yeah, it's totally original. Does a really deep dive almost every day analytically into like Crunchbase type data and graphs and charts it and makes sense of it. He's all about SaaS startups. So if you're doing anything in SaaS and you're not reading his stuff, then you're pretty foolish.
SaaStr's another one for SaaS. Amazing.
SaaStr, yeah.
And then finally, your most recent angel investment and why you said yes.
I haven't done one for a while, but the most recent one I did late last year was NerdWallet. And why I said yes was, if you don't know who these guys are, they basically started out as a search engine for credit cards, and now they're for anything personal finance. But I just love the business. They bootstrapped, and their first round of funding was a Series A at $75 million last year. But they bootstrapped, and they were, SEO driven. They had sort of just took, opportunity in the long tail of SEO for several years and grinded it out until they sort of bubbled to the top. And I just love the ethos that came from that. And I think as they continue to expand the company, no matter how much money they raise, they're going to act like the bootstrapped company they were from the beginning.
Absolutely. Constraint enforces creativity.
Totally.
Yeah. Well, Sean, thank you so much for coming on the show. It's been such a pleasure having you on and hearing your incredible journey. Thank you so much for sharing it with us.
Yeah, thanks for having me. Good luck. Look forward to listening to it.
And again, I would like to give a huge thank you to Sean for giving up his time today to be on the show and sharing his amazing journey. And if you're loving the show and would love to see more resources and hear more podcasts, then head on over to www.syndicateroom.com, where you can find our learning platform, which is the home for all the resources and podcasts built around the show. And as always, it's been an absolute pleasure bringing you the show, and we look so forward to bringing you next week's show with Max Kelly at Techstars. But before we leave, we'd like to remind you that early stage investing is risky. Therefore, please ensure to do the proper due diligence prior to making the investment. Thank you so much, and we look forward to seeing you in next week's episode.